Have you ever stopped to think if certain personality traits, the ones we just kind of blame on culture, could actually be costing you real money? Well, today, we're going to dive deep into the high-stakes world of stock market investing. We'll see if a really common cultural idea might just hold the key to why some investors, well, why they don't do so well.
All right, so let's kick things off with a myth that's, really baked into our culture, especially around money and finance. It's this idea that to win big, you have to be aggressive. You have to take these massive risks. We're going to really put that beat the market mentality under the microscope and see how it actually holds up when there's real money on the line.
I mean, we've all heard this one, right? Boys will be boys. It gets thrown around all the time, usually to kind of excuse some loud competitive behavior. It hints at this idea that there's some kind of, a hardwired instinct for taking risks.
Okay, but what happens when that mindset graduates from the playground to the trading floor? Does that super aggressive, I've got this, I can beat the market kind of attitude, does it actually lead to bigger paydays? Does it work?
Well, the good news is we don't have to guess. There was this landmark academic study that tackled this exact question, and honestly, its conclusions have been shaping how people think about finance for years. So let's dig in and see what they actually found.
So the researchers Barber and Odean, they didn't mess around. This wasn't some small online poll. They did a massive analysis, digging into the actual trading records of 35,000 different households. And they watched them for a 6-year period. Their goal was pretty straightforward. Figure out if gender had any effect on how people trade and, more importantly, what the results were.
Okay, and this is where things get really interesting. Because the numbers they crunched, the data they pulled out, it was crystal clear. And for a lot of people, it was the exact opposite of what they expected.
So first up, they just looked at how often people were trading, and the difference they found was huge. Single men were trading a whopping 45% more often than single women. I mean, their portfolios were just in constant motion. Buy, sell, buy, sell.
Now, your first thought is probably, okay, so all that action, all that time spent glued to the market, that has to lead to better results, right? I mean, it makes sense. More trades should mean more profit, shouldn't it?
Well, nope. The data showed the complete opposite. Once you factored in all the transaction costs, all the fees for buying and selling, the portfolios of single women actually earned more money. The investors who are less active ended up on top. Wild, right?
And we're not talking about a tiny difference here. On average, all that extra trading cost men 1.2 percentage points in returns. Every single year. I mean, think about that compounded over a lifetime of investing. That is a staggering amount of money just gone.
So what on earth was going on? The study was really clear that it wasn't because men were worse at picking stocks. That wasn't it. The real issue was something deeper. It was a powerful psychological bias that was pushing them to make all those costly trades.
And the culprit has a name: overconfidence. It's that classic human tendency to think you're a little bit smarter, a little more skilled, or that you've got better info than you really do. And in the world of investing, it's that dangerous belief that you, personally, can consistently time the market and outsmart everybody else.
So where does this stuff even come from? Well, the researchers pointed to a whole cocktail of reasons. You've got societal pressure, encouraging men to be competitive in areas like finance. And then there's this funny psychological quirk called illusory superiority, which is basically just the fancy term for how most of us think we're better than average. You mix those things together, and bam, you've got the perfect storm for trading way too much.
Okay, I know what some of you are probably thinking. Dude, this study is from the 90s. That's ancient history. And you're right, it was a totally different world. But here's the thing. The lessons from this research are probably more important right now than they have ever been.
See, back when this study happened, every single trade cost you cold hard cash in commissions. That fee was like a natural speed bump. It made you stop and think twice before you hit the buy button. But today, with all the zero-commission apps and crypto markets that never sleep, that financial friction has totally vanished. And what's the result of that? Well, the main barrier that stopped you from acting on every single overconfident impulse is just gone. The whole gamified lightning-fast world of modern trading platforms has basically taken the exact problem Barber and Odean found and put it on steroids.
So what's the big takeaway here? Let's be really clear. This isn't actually a story about men versus women. Not at all. It's a powerful lesson about human psychology, about how our own brains can trip us up. The study's findings point to a smarter way to invest that works for literally everyone, no matter who you are.
The data pretty much spells out the playbook for us.
Step 1, you have to be honest with yourself and acknowledge your own potential biases. We all have them. Step 2, embrace patience. You have to really get that for most people, trading less is actually more profitable. And third, use simple, smart strategies like automating your investments into low-cost, diversified funds. Because at the end of the day, the market doesn't reward frantic, panicked action. It rewards discipline.
So, when all is said and done, this incredible research leaves us all with a tough but really essential question to ask ourselves. It forces us to look in the mirror and think about our own financial future. Are our gut instincts and our impulses helping us, or are they our own biggest enemy?